How can everyday investors build wealth reliably without trying to beat the market? Welcome to Grow Reads, where we break down life-changing books into powerful lessons. The key to reliable, long-term wealth building is not stock picking, market timing, or chasing hot trends. It's embracing the power of long-term investing through low-cost index funds. This is the central message of John C. Bogle, the founder of Vanguard Group and the creator of the first index mutual fund, spent decades helping ordinary investors succeed by ignoring Wall Street hype and sticking to sound, long-term investment principles. Key takeaways. 1. Investing is not speculating. Bogle draws a crucial distinction between investing and speculating. Investing is about buying a broad cross-section of the market and holding it for the long term, while speculating involves attempting to time the market or pick the winning stocks. Speculators bet that they can outsmart others, but history shows that most fail. True investors, on the other hand, accept that markets will fluctuate, but that over time, the entire market tends to grow. By buying and holding a low-cost index fund that mirrors the total stock market, investors can reliably share in that growth. 2. Reversion to the mean. One of Bogle's most important principles is reversion to the mean. This means that over time, the performance of hot mutual funds or individual stocks tends to regress back to average. A fund that performs exceptionally well over a few years often cools off, and one that lags may catch up. This makes it dangerous to chase performance. Instead, Bogle argues, it's wiser to invest in the entire market because the market average is what most investors will eventually earn anyway, especially after costs. 3. The cost matters hypothesis. In contrast to the widely debated efficient market hypothesis, Bogle proposes the cost matters hypothesis. His argument is simple: even if markets aren't perfectly efficient, costs are certain, and costs like management fees, taxes, and transaction costs eat into your returns relentlessly. Over the long term, minimizing costs is the single best way to improve your investment outcomes. Index funds do this by eliminating high fees and trading expenses associated with active management. 4. The arithmetic of investing. Bogle explains that all investors as a group must, on average, earn the market return. However, because of costs, most will earn less than the market return. For example, market return equals 8%. Average fund expense equals 1.5%. Investor return equals 6.5%. These differences seem small annually, but over decades the compounding effect becomes enormous. A 1–2% difference in annual returns can mean hundreds of thousands of dollars in lost wealth. 5. Why index funds win. Bogle famously championed index funds because they track the entire market or broad segments of it, have extremely low fees, require minimal trading, which reduces taxes and costs, eliminate the risk of picking the wrong stock or fund. He provides extensive data showing that over time, index funds outperform the vast majority of actively managed funds. Few managers beat the market consistently, and identifying them in advance is nearly impossible. 6. The miracle of compounding returns. Compounding is a powerful force in investing. The earlier and more consistently you invest, the more you benefit from compounding interest and returns. However, compounding only works to your advantage when fees and taxes don't erode your gains. This is another reason Bogle insists on low-cost, tax-efficient index funds. 7. The tyranny of compounding costs. Just as returns compound, so do costs. Bogle shows how paying even 2% annually in fees can reduce your wealth by more than half over a lifetime of investing. Example: a $10,000 investment earning 8% per year for 50 years grows to over $469,000. But with a 2% annual fee, it only grows to $184,000, a difference of nearly $300,000 lost to costs. Bogle's advice: own the entire market at the lowest possible cost. 8. Don't try to pick the winners. Most mutual funds underperform the market, especially after fees. The few that do outperform rarely maintain their edge. Even if a fund beats the market this year, it probably won't next year, Trying to pick the right stock or fund is like trying to find a needle in a haystack. Index funds, by contrast, let you own the whole haystack. 9. Time is your ally, impulse is your enemy. Staying invested is critical. Market downturns are inevitable, but they're usually followed by recoveries. Those who panic and sell often miss the rebound. Bogle urges investors to ignore short-term market noise and to stick with their long-term strategy. Time in the market is more important than timing the market. 10. The role of bonds in a portfolio. While stocks are the engine of long-term growth, bonds play a stabilizing role. Bogle recommends owning some bonds to reduce volatility, especially as you age. A common rule of thumb, your bond allocation should roughly equal your age. So a 30-year-old might hold 30% bonds, while a 70-year-old might hold 70% bonds. This provides a cushion during market downturns. 11. Diversification is essential. Diversification reduces risk. Index funds offer automatic diversification by holding hundreds or thousands of companies. This protects investors from the failure of any single stock or sector. Bogle recommends broad-based index funds such as Total Stock Market Index Fund, S&P 500 Index Fund, Total Bond Market Index Fund. These funds offer maximum diversification with minimal cost. 12. The folly of market timing. Trying to predict when to get in and out of the market is nearly impossible. Investors who attempt this often miss the best days in the market. Bogle presents data showing that being out of the market for just a few key days can dramatically reduce your long-term return. The most successful investors stay invested through ups and downs. 13. Past performance is not predictive. Mutual fund advertisements often tout stellar past performance. But Bogle cautions that past returns do not predict future success. Many high-performing funds attract huge inflows, only to underperform in subsequent years. Bogle's solution: ignore past performance and stick to index funds. 14. Simplicity is the ultimate sophistication. Complex investing strategies often backfire. Bogle advises a simple portfolio of low-cost index funds tailored to your goals and risk tolerance. A basic portfolio might include 60% total stock market index, 40% total bond market index. Such a portfolio requires little maintenance, low cost, and historically strong performance. 15. Investing for the long run. Bogle's mantra is stay the course. Long-term investing through thick and thin is the surest path to wealth, he advises. Don't get distracted by short-term news. Don't trade frequently. Don't speculate. Don't let emotions dictate decisions. Focus instead on steady contributions and holding a diversified portfolio. 16. The impact of taxes. Taxes reduce returns. Actively managed funds tend to have higher turnover, which leads to more taxable events. Index funds being more tax efficient minimize this drag on performance. Investing in tax-advantaged accounts like IRAs and 401(k)s further shields your gains from taxation. 17. The power of staying the course. Many investors abandon their plan during market crashes, but those who remain disciplined are rewarded. Bogle cites examples from the 2008 financial crisis and other downturns to show that patient investors ultimately come out ahead. Your biggest advantage is your behavior. Don't panic, stick with your plan. 18. Avoid the noise. Financial media thrives on sensationalism. Headlines, stock tips, and expert predictions are mostly noise. Bogle urges readers to tune it out. Focus instead on your long-term goals, your asset allocation, and your discipline. The best investors are often those who do the least. 19. Owning the market equals owning capitalism. By owning an index fund, you own a slice of the entire economy. You're invested in every major company, every innovation, and every sector. This approach aligns your wealth with the collective success of global enterprise. Bogle calls this the ultimate act of faith in the future of capitalism. 20. Legacy and philanthropy. Bogle ends the book with a call to responsibility. Wealth once built should be used wisely. He advocates for charitable giving and for teaching future generations the value of financial discipline. He also emphasizes that investing should serve a purpose, not just accumulation for its own sake, but freedom, security, and the ability to contribute. Conclusion: the common sense path to wealth. John Bogle's The Little Book of Common Sense Investing offers a clear, powerful, and deeply rational approach to building wealth. It stands against the noise of Wall Street and instead promotes a philosophy of patience, simplicity, and cost efficiency. By embracing index investing, minimizing costs, avoiding speculation, and staying the course, you give yourself the highest probability of financial success.